You pull $20,000 from your 401k. You've already claimed Social Security. You figure you'll owe taxes on that $20,000. Standard math, nothing surprising. Except IRS doesn't see it that way. That $20,000 withdrawal triggers a formula most people have never heard of. It's called combined income. And because of it, a portion of your Social Security, money you assumed was sitting outside the tax equation, suddenly becomes taxable too. So instead of reporting $20,000 in income, your return shows $37,000. I remember sitting with a retirement tax return at 2 in the morning, staring at a number that made no sense, trying to figure out where that extra income came from, running the same calculation over and over, and slowly realizing this system was never designed for regular people to untangle on their own. The thresholds that trigger this were written into law in 1983 and have never been adjusted for inflation. Back then, very few retirees hit those limits. Now most do, quietly, without warning. So if you're somewhere between 55 and 65, thinking through when to claim Social Security and how much to pull from your 401k, that $20,000 becoming $37,000 problem is real, and it costs real money. But here's what makes this harder. That's actually not the worst part. The worst part is a completely separate issue that most people don't discover until after the damage is done. If you retire before 65, before Medicare, and you follow the advice that gets repeated everywhere about Roth conversions, there's a specific rule change in 2026 that can erase $20,000 in health insurance subsidies. One decision, 1 year, gone. The people giving that advice aren't wrong in general. They're just not accounting for where the law actually sits right now this year for people in your exact situation. Before we get to how to protect that money, you need to understand the first trap. Because most people walk straight into it, and it comes disguised as the safest, most conventional retirement advice you'll ever hear. Most people assume Social Security works like a simple deposit. You claim it, you receive it, and whatever taxes apply, you pay on that amount. That's how most income works. That's not how this works. The IRS uses a separate formula to decide how much of your Social Security is taxable. It's called combined income, and it's calculated by adding your adjusted gross income, any non-taxable interest, and half of your Social Security benefit. If that total crosses certain thresholds, up to 85% of your Social Security becomes subject to income tax. Not 85% of the benefit disappears, but 85% of it gets added to your taxable income. For a lot of retirees, that's a significant number sitting quietly in a column they didn't expect. Here's where it turns into a trap. Those thresholds, $32,000 for married couples at the lower bracket, $44,000 at the upper, were set in 1983. They have never moved, not once. Inflation has eroded everything around them, but these numbers have stayed exactly where they were 40 years ago. Which means a retiree today with a perfectly ordinary income can hit limits that were originally designed to catch only the wealthiest households. Take Mark and Linda. Both 63, retired, receiving Social Security. Their combined income is sitting right around $43,000, just under that upper threshold. They decide to pull an extra $2,000 from their 401k to cover a trip they've been putting off. Reasonable. It's their money. They figure they'll pay taxes on $2,000. What actually happens, that $2,000 pushes their combined income past $44,000. Now 85% of their Social Security benefit, not just the extra $2,000, but a portion of what they were already receiving, becomes taxable. The IRS sees an additional $1,700 in taxable Social Security on top of the $2,000 withdrawal. Their taxable income just jumped by $3,700. At a 22% rate, they're losing more than 40 cents on every dollar they pulled. They withdrew $2,000 and effectively paid tax on nearly double that. That's the torpedo. It's not that 401k withdrawals are taxed. Everyone knows that going in. It's that each dollar you pull has a multiplier effect on your Social Security. The more you withdraw while receiving benefits, the more of those benefits get dragged into taxable territory. And because the thresholds haven't moved with inflation, it happens at income levels that feel completely normal. I've watched people do this without realizing it, not because they were careless, but because nothing in the paperwork flags it. The 1099 from Social Security and the 1099-R from the 401k arrive in separate envelopes. The connection between them isn't visible until the return is done and the number doesn't add up. The long-term cost isn't just 1 year's tax bill. If you're pulling from your 401k regularly while receiving Social Security, this multiplier runs every single year. Your account depletes faster than your projections showed, sometimes 5 to 7 years ahead of schedule. That's not a rounding error. That's a meaningful shift in how long your money lasts. This doesn't mean you made a wrong decision by claiming Social Security when you did. The system layers these rules deliberately in ways that make the safe choice. Claim early. Leave the 401k alone, quietly expensive over time. It's not a villain. It's an incentive structure that was never updated, and most standard retirement advice doesn't account for what it actually costs you today. So what do you do if you have a pension on top of all this? That changes the math significantly, and not in a simple way. Mark and Linda thought the trip was behind them. They paid the tax bill, adjusted their budget, and moved on. 2 years later, at 65, Mark's pension activated. It wasn't a surprise. They'd planned for it. A fixed monthly payment, reliable, permanent. On paper, it looked like stability. What they didn't see coming was the bill that arrived with their Medicare enrollment packet. Medicare Part B premiums aren't flat. They're income-based, and the income they use isn't your income from this year. It's your income from 2 years ago. That's the IRMAA lookback window. The surcharge you pay in 2026 is calculated from your 2024 tax return. So that extra 401k withdrawal Mark and Linda made at 63, the one that already cost them on the tax torpedo, came back around again. Their 2024 Maggie was higher than it should have been, and now their Medicare premiums reflected it. IRMAA isn't a small adjustment. For married couples in 2026, the standard Part B premium sits around $185 per person per month. But cross the first income threshold, roughly $212,000 in Maggie for a couple, and that premium jumps by hundreds of dollars per person, per month, for the entire year. One decision, 2 years earlier, now running as a recurring charge, and with Mark's pension now adding a fixed floor to their income every month. Their ability to manage that Maggie going forward became much harder. That's the part about pensions that the retirement brochures don't explain clearly. A pension provides certainty, and certainty has real value. But it also means your taxable income has a floor you cannot lower. You can't turn it off in a high-income year. You can't defer it. It's there every month, whether you need it or not, stacking on top of Social Security and any 401k distributions. For anyone trying to stay under IRS thresholds, for IRMAA, for the Social Security Torpedo, for anything, a pension removes one of your main tools for managing income timing. The trade-off isn't that pensions are bad. It's that a pension plus a 401k plus Social Security, all running simultaneously, creates a very high combined income floor. And once you're above certain thresholds, the IRS has multiple systems, not just one, waiting to collect on the difference. For Mark and Linda, the math looked like this: pension income, Social Security already in payment, and a 401k withdrawal from 2 years ago that they'd already mentally written off. 3 separate line items, each one reasonable on its own. Together, they triggered a Medicare surcharge that added thousands of dollars to their annual health care costs, for both of them, for the full year. I've seen people sit across from this situation genuinely confused, not because they made reckless choices, but because nobody showed them how these systems interact. The 2-year look back is the part that catches people most off guard. By the time the IRMAA bill arrives, the income decision that caused it is ancient history. There's nothing to adjust. You just pay. Now, you might be thinking, okay, so the answer is Roth Conversion. Get the money out of the 401k before these thresholds become a problem. Manage the income now. Pay taxes at a lower rate. Protect yourself later. That advice has been circulating for years, and for a long time, it was genuinely good guidance. But in 2026, for anyone who retires before 65, that playbook has a specific flaw that most financial content hasn't caught up to yet. And if you follow it without understanding this one rule change, it can cost you more in a single year than the taxes you were trying to avoid. Subscribe to this channel. Every week we track exactly these kinds of law updates so you don't find out about them after the fact. Picture someone who retired at 60. They're healthy, their savings are in reasonable shape, and they have a plan. They're 5 years away from Medicare, so they're buying health insurance through the ACA marketplace. They've done the math on premiums, they know roughly what to expect, and they've heard from every financial corner of the internet that this is the moment, the golden window between retirement and RMDs, to do Roth conversions. Lock in lower tax rates now. Move money from the 401k into Roth. Smart, conventional, widely recommended. I was sitting with a close friend who had just retired early at 60. We were going through his numbers over coffee, and I was about to tell him the same thing. Convert as much as you reasonably can this year while your income is low. Then I pulled up the ACA rules for 2026, and I stopped talking. What changed is this. During the pandemic years, enhanced subsidies were extended that effectively removed the income ceiling for ACA assistance. That expansion has ended. The law has returned to its original structure, and that structure contains what's called the subsidy cliff. If your modified adjusted gross income exceeds 400% of the federal poverty level, you lose every dollar of your health insurance subsidy. Not a gradual phase out, a cliff. $1 over the line and the entire subsidy disappears. For a couple in 2026, that threshold sits around $78,000 in MAGI. Below that line, with the subsidy, they might pay around $2,400 a year for health coverage. A real number, manageable. Above that line, the same policy costs closer to $20,000 a year out of pocket. The subsidy was bridging a $17,600 gap. Cross the threshold and that bridge is gone. Now run the Roth conversion math. Someone in this situation decides to convert $20,000 from their 401k to a Roth IRA. Their income was sitting at $65,000. The conversion pushes them to $85,000, past the cliff. They save roughly $4,000 in taxes on that conversion. They lose $17,600 in health insurance subsidies. The net result is a $13,600 hole in their finances for that year. And because health insurance renews annually, they have to navigate this same cliff every single year until Medicare kicks in at 65. The tax savings were real. The strategy was textbook. The outcome was a financial loss that took one evening to create and will take years to absorb. Healthcare costs at 55 to 64 are the single largest unplanned expense most early retirees face. Not taxes, not investment losses, health insurance. And yet most retirement optimization conversations are almost entirely focused on the tax side, with healthcare treated as a secondary variable to plug in at the end. In this age bracket, that priority needs to flip. Protecting your ACA subsidy isn't a nice to have. For someone retiring before Medicare, it's the difference between a manageable retirement and one that bleeds cash from the first year. The mechanism here isn't complicated once you see it. MAGI is the number that governs everything: your tax bracket, your Social Security taxation, your IRMAA exposure, and now your ACA subsidy eligibility. Every income decision you make flows through that single figure. A Roth conversion increases MAGI. A large 401k withdrawal increases MAGI. Even certain investment gains can push MAGI in a direction you didn't intend. Managing retirement income isn't about optimizing one variable at a time. It's about understanding that all of these systems are reading the same number and responding to it simultaneously. So the question isn't whether Roth conversion is a good idea. In the right window, it absolutely is. The question is which window you're actually in, and what the rules of that window cost you if you get the timing wrong. That brings us to the sequence. Because there is a specific order to this that protects you on multiple fronts at once, and it runs opposite to what most people assume. Most people think about retirement income as a question of what to spend first. Cash first, then investments, then the 401k. Or the reverse, pull from the 401k early, let the Roth grow untouched. The order feels like a preference. It isn't. The sequence you choose determines which tax systems activate, when they activate, and how much they take before you see a dollar. The strategy I'm going to walk through runs in 3 phases. Each phase has a different priority, and the priorities shift because the rules shift. Phase 1 starts the day you retire and runs until you turn 65. This is the most sensitive window in the entire sequence, and it's the one most people get wrong. Your only job in this phase is to keep your MAGI below the ACA subsidy cliff. Everything else is secondary. Not Roth conversion, not tax bracket optimization, not investment rebalancing that triggers gains. Protecting that subsidy is the priority because the cost of losing it, up to $17,600 a year, will outrun almost any tax benefit you could capture by moving faster. In practical terms, that means living primarily off cash reserves and taxable brokerage accounts during this window. Long-term capital gains from a brokerage, if managed carefully, can stay at a 0% rate for couples with MAGI under roughly $94,000, well below the ACA cliff. 401k withdrawals should be minimal and calculated, not reactive. And Roth conversions, if done at all, need to be sized precisely so they don't push MAGI past the threshold. A $5,000 conversion that costs you $17,600 in subsidies is not a win. Run the full number before you move. I've sat with Medicare Part B statements. 40 pages of itemized charges, line after line of costs, most people never anticipated. Looking at those documents made one thing clear. The years before 65 are when you build the financial cushion that absorbs what comes after. Letting MAGI run loose in this phase doesn't just cost you on health insurance. It sets the IRMAA lookback clock running at a higher number than it needs to be. Social Security also stays off the table in Phase 1. Every year you delay past your full retirement age, your benefit grows by 8%. That's a guaranteed inflation-adjusted return on a deferred claim. In a phase where you're already managing income carefully, adding Social Security to the mix raises your combined income and increases the risk of the tax torpedo. Leave it alone. Phase 2 opens at 65 and runs to 74. Medicare is now active. The ACA cliff is no longer a constraint. This is when the Roth Conversion window genuinely opens. And thanks to the CE Cure 2.0 Act, it's longer than most people realize. For anyone born in 1960 or later, the age at which required minimum distributions kick in is now 75. That's 2 additional years beyond what the previous law allowed. 2 more years of converting 401k money into Roth at controlled tax rates, without the IRS forcing your hand. The actual golden window isn't at retirement. It's here between 65 and 74. When you have Medicare, you have flexibility and you have time. During this phase, convert deliberately. Stay within your current tax bracket. Watch Maggie relative to IRMAA thresholds. They still apply. But you're no longer defending against the subsidy cliff, which means you have considerably more room to work with than you did in Phase 1. Phase 3 is straightforward. At 70, claim Social Security. By this point, if you've delayed from your full retirement age of 67, your benefit has grown by 24%, 8% per year for 3 years. That's a permanent increase to an inflation-adjusted income stream you cannot outlive. For someone whose monthly benefit at 67 would have been $2,500, waiting to 70 brings that to roughly $3,100 per month. Over a 20-year retirement, that difference compounds into a significant sum. The reason this sequence works is that it treats the 3 major tax systems, ACA subsidy rules, IRMAA, and the Social Security combined income formula as a single connected problem rather than 3 separate ones. Most advice addresses them one at a time. This framework holds all 3 in view simultaneously and sequences the decisions so you're not solving one problem while accidentally creating another. The math won't be identical for everyone, but the logic holds across most situations in this age bracket. Protect the subsidy first. Convert in the real window. Delay Social Security until the return justifies it. Before you apply any of this, 3 questions. They're not complicated, but your answers change which parts of this framework matter most for your specific situation. First, do you have a pension? If yes, your taxable income already has a floor you can't control. That floor affects every threshold we've talked about: the Social Security Torpedo, IRMAA, ACA eligibility. You need to know exactly where that floor sits before you make any withdrawal or conversion decision, because your margin for error is narrower than someone without a pension. Second, are you retiring before 65? If yes, ACA subsidy protection moves to the top of your priority list, above Roth Conversion, above tax bracket management, above almost everything else. The math on this is not close. A $17,600 annual subsidy is not a variable you optimize around. It's a constraint you design your income strategy to stay inside. Third, can you cover your living expenses without Social Security? If yes, delay. Every year past your full retirement age adds 8% to a permanent inflation-adjusted benefit. If you genuinely need that income to meet basic expenses, take it. Survival is not a suboptimal strategy. The framework bends around your actual life, not the other way around. Now, I want to address something directly because I hear it often and it deserves a straight answer. A lot of people in this age group want to claim Social Security at 62 because they don't trust that it'll be there later. The feeling is completely understandable. You've paid into this system your entire working life. The news has been uncertain for years, and taking the money now feels like the rational move. Get it while it's there. I'm not going to tell you that feeling is wrong, but I'd ask you to reframe the question slightly. This isn't really a political risk calculation. It's a longevity risk calculation. Social Security, at its core, is insurance against outliving your other assets. If you live to 85 or 88 or 92, which is not unlikely for someone who's healthy at 60, the difference between claiming at 62 and claiming at 70 becomes one of the largest financial decisions of your retirement, not because of politics, because of math and time. Claiming early to protect against a system failure that may never come is a real trade-off. Claiming early and living another 30 years is a different kind of exposure. The framework here gives you enough flexibility in Phase 1 and Phase 2 that delaying Social Security doesn't mean going without income. It means sequencing your other sources carefully enough that you can afford to wait. A retirement income plan isn't a single-year tax return. It's a 30-year cash flow decision with multiple moving parts that interact with each other in ways that aren't obvious until you see them laid out together. The traps we covered, the tax torpedo, IRMAA's 2-year lookback, the ACA subsidy cliff, none of them are inevitable. They're the default outcome when you follow generic advice without accounting for your specific income sources, your retirement age, and the rules that apply right now in 2026, not the rules from 5 years ago. The decision tree is simple. The sequencing takes some work. But the alternative, optimizing one piece at a time and letting the other systems run unchecked, is what turns a well-funded retirement into one that quietly costs you more than it should, year after year, in ways that don't show up until the bill arrives. Leave a comment with your situation. Pension or no pension, retirement age, whether you're already on Social Security, and I'll address the most common scenarios in an upcoming video. Subscribe to Wes Investor so you don't miss it. These rules get updated, the thresholds shift, and the gap between generic advice and what actually applies to you tends to grow wider every year. I'll see you in the next one.